Yes. So today we're going to discuss the next topic in our ICMI syllabus, which is working capital management. Working capital management has many units in this chapter. The first one that we will discuss is going to be your raw material inventory calculation. That is immediately after the intro. That a little bit of intro we'll be discussing right now. Okay, you already know what is the meaning of working capital management, don't you? Working capital, as we've already studied in the earlier topics, what is working capital? Your current assets minus your current liabilities. And what does your current asset includes? Your current asset includes your cash, your receivables. Receivable means your debtors. Okay, your inventories, your marketable securities. Marketable securities, your shares. If you're buying and selling shares, and if that is part of your inventory, then that will only be counted in your current asset. Otherwise, it won't. Investments are generally held with a long-term objective. These are the securities which is held for a short-term objective. Only if it's a short-term objective investment will be counted under current liability, current assets. Sorry, otherwise not. Okay. So there is a detailed discussion about what is working capital. Working capital means what? I need money, funds to run my day-to-day operation, right? It's written over here, day-to-day operation. And to fund that, I must have enough money. And why studying this topic becomes very important? Because without money for our day-to-day operation, our business is not going to survive. If I have to survive my business, I have to plan. I have to plan my cash. I have to plan how much money I receive from debtors. To get that, I should plan the credit. Are you aware of credit policy? Credit policy means for each customer, how many days do I allow them to repay back to me? That's your credit policy. Same thing works with when I purchase. I purchase, say, raw materials. I have to pay them. The more time I take from them is better for me. Similarly, the less time I give to my debtors is better for me. You understood? Basically, do I have enough cash with me to run my day-to-day operation? One cash I have to maintain, other I have to receive from my debtors, right? So the lesser the time I give to them, better. But generally, because of competition, we have to abide by what is my competitor giving. Otherwise, nobody will come to me. For example, if I'm not giving credit policy at all to my debtors, what will customers do? Oh, this shop does not give, let me go to the next shop. They give 30 days time. So everybody will walk into that shop and start buying from there. I'm sure you've gone to these gold showrooms. Now, even your salon, not just for women, even for men, the salons that you have, you go there, they say, please buy 1 year membership card, pay so much, buy a membership card. What is this concept? They are taking money for 6 months in one shot now. What are they trying to do? They are trying to build on liquidity. They're taking money from the customers right now and giving them service for the future date. Thereby, they are taking money from us right now and they are funding their operations. Ideally speaking, you should not give because your liquidity is hit, no? Immediately today, you're paying for 6 months. Is it not hitting your pocket? Right? So therefore, but they are cleverly launching this to you. That pay for 1 year now only, GST is free. Attractive because GST I don't have to pay, I pay off 1 year. But thereby I ended up paying 10K immediately now, which is for 10 months. So these are the kind of offers they very cleverly give to us. We don't realize what they are doing, but they are trying to build on their liquidity or they are financing their own liquidity by collecting money upfront. That is one way. And another way is giving credit policies, giving more time. But that will hit my pocket because I have to depend on bank OD to run my business operations. So all this is like a balance you'll have to maintain to run your day-to-day activities of the company. Now again, the concept of working capital in your material, they have discussed two concepts. One is the gross working capital, another one is a net working capital. Gross working capital means your total current assets. Simply what? In your balance sheet, you will see on the asset side in the balance sheet, whatever is your total current assets, that's called your gross working capital. Simple. Simply the total of all the current assets. What is net working capital? As the name suggests, your net working capital is simply current assets minus current liabilities. So what is net working capital? Net working capital is nothing but current assets minus current liabilities. What was gross working capital? Gross working capital was simply the total of all the current assets. Simple. Right. The next concept that we will be discussing is zero working capital. What is zero working capital? As they have beautifully shown in the box in your screen, zero working capital means you have inventory, you have receivables minus the payables. Payables is my creditors amount that I need to pay them. How much money I have from my debtors in the form of receivables, and then how much money I will get by selling my stock. So all this will is giving you what is called as zero working capital. Zero working capital is a terminology which is used for this formula, which is nothing but inventory plus receivables minus payables. Fine. Now, what is the meaning of current assets? Current asset is any asset which you hold for 12 months and not beyond. If you're holding any asset for more than 12 months, then they become your long-term assets. We are not interested in any long-term assets in this topic. We are only focusing our attention on the current assets. Why? Because I'm saying if you are holding a stock for more than 12 months, then that becomes a long-term asset. It can't be considered under the current asset. So periodicity is also important. Periodicity is holding the assets for how many number of months or what is a period that becomes important. So, and again, asset which is held for only trading. Now I have furniture in my business. This is a furniture I used to sit. I don't buy and sell furniture. So if there's a difference here. So buying, selling of furniture, now that furniture will come under the classification or my definition of current asset, where I'm using furniture to only sit and it's only for my office space or home space, whatever. Okay, here we are only discussing trading. So it's my office space furniture. Now that becomes my fixed asset. So what I'm trying to say is in your current asset definition, we will take only that asset which is used for trading and not for your office premises, which will then be classified under the fixed asset definition. Okay. This 12 months, I already told you. Generally, what are the different kinds of current assets that we see? You know, inventory. Under inventory, the more focus we will give on the classification of inventory when we go to problems. So you must be aware, inventory is just not inventory. Inventory will have raw materials because we need to value raw materials. We need to value work in progress, a work in process, whatever we call them. And then finally, the finished goods. This classification is important from the problems perspective. So that's why we are reading step by step. Okay. Receivables is pretty simple. You know, either it is a debtor or it is your bills receivable. Cash and cash equivalents, there is nothing to explain. Prepaid expenses. If I have to tell you prepaid expenses, it means like rent in advance. Rent is an expenditure which I've already paid in advance. I don't have to pay again in the next month. So isn't it not my current asset? So therefore, these are the kind of assets which we'll be considering when we are calculating the working capital. Now again, what are the different liabilities? Same definition. It should be part of your normal operating cycle. It should be part of your trading. And again, it should be a liability for 12 months only and not beyond 12 months. What are the different kinds of liabilities that you'll come across in this chapter? Is your trade payables, bills payables, wages and salary. That's it. No loans, no bank loans, no term loans. All of them are not coming here. Okay. One of the critical factors of working capital is You can't have too much working capital also. You can't have too little working capital also. Having too much working capital is also bad planning. Having too little working capital is also very bad planning. Okay. So you have to strike a balance, which is important. Striking a balance is what you as a financial managers have to plan when you work in a company. So therefore, planning of working capital is very, very critical for any organization to run its operations effectively. Okay. So they have discussed some of the dangers of having too high also. Too high means it will have unnecessary, so you are unnecessarily stocking up your stock or inventory. Too much inventory I have put. So I'm a, suppose a rice trader. Okay. Too much of rice bags I have bought and stored. Too much of rice bags I have, and it's a rainy season. What can happen? My rice will get spoiled. I'm not able to move them quickly to my customers. So having too much of stock is also bad. At the same time, having too little of rice when it is I'm having demand and people are wanting to buy more and more, and I don't have, right? So planning is very, very important. You have to analyze your, you know, your month on month sales. I don't know whether you've observed this. You've seen that Anand Sweets shop, Anand in Jayanagar. You've not observed, especially when it is Diwali season. Their sales are rocket. It touches the rocket. Okay, so what they do? They have a small sit out for these chats and food restaurant kind of a small portion they have. They shut that place because no people walk in for charts and eateries. People walk in only to buy dry fruits, sweets because Diwali season, and they want more and more customers to come and buy those commodities. How did they plan that? Last years they have analyzed their demand. So during the Diwali, which is like October or November, more and more people walk in for buying sweets and dry fruits because they exchange. That's a part of our culture. We exchange either dry fruits or sweets to our customers, relatives. So it's part of our culture. Nobody comes there and buys and eats chat. So they close that and they have stocked up all these dry fruits, huge space only for dry fruit boxes. So what is this? There is a proper planning which has undergone, and they have planned for these 2 months. I'm going to shut my eat out and I'm going to stock dry fruits and sweet boxes. So this is because I'm seeing to have those beautiful boxes, inventory, stock those sweets, perishable. You have to plan so well. And at the same time, dry fruits. Dry fruits not perishable, but then you have to buy those dry fruits also, right? That also involves cost. So how much planning goes in running even a small sweet shop? We are talking about a big company and how well they should plan their working capital management. That becomes equally important. So it's not a very small job, it's a huge task on the shoulders of a financial manager. So these small, small things are very, very important, which you need to understand. Like I said, when I was talking about a small sweet shop, so every nature and size of the business matters when you're planning your working capital. Your production policies. If you are a manufacturing sector, then your planning for working capital is different. Okay. In case you're planning a growth or an expansion, like I said, in Diwali season, your plans is different. Your other months are different, right? So you need to plan a little ahead of time. Okay. So when is sales your maximum? I don't know whether you know this or not. Ladakh is a tourist spot in India. And in Ladakh, there are people who can't travel to Ladakh in the months of, say, Jan to May. You can't go there. It's freezing cold. It opens up only in June to November. That's when a lot of tourists walk in there. And for people who are usually set up in Manali, businesses I'm talking about, they then expand in Ladakh because they themselves go to Ladakh when it opens up. Otherwise, the military closes that entire Ladakh region because it's too much of ice, freezing cold, it's in minus. People don't go there. So generally, people who are in Manali and in the borders of Ladakh, they plan that expansion of their businesses in Ladakh because a lot of tourists come in the month of June and November. So it's a seasonal business. But to manage their business, they have to plan. For those months, they need more money. more inventory is required. Lot of eat outs, especially, these hotel businesses, they open up from June to November there. So now they have to plan, right? They have to stock in all the rice, vegetables, fruits. So all this depends on your season to season, your growth, your expansion. So working capital is different from month to month for every business. So we have to analyze that. Of course, then each and every things you have to see terms and conditions of sales and purchases, dividend policy. Dividend policy means what? How much I remember in the earlier chapters we had discussed this. Dividend policy means if I have 100 rupees profit, how much am I going to keep in my retained earnings and how much I'm going to pay to my shareholders. That's your dividend policy. Now, if I decide to pay, say, 30 to my shareholders, well, how do I pay? I need money, right? Do I have enough money? So in that month, if I've decided to pay dividend, I have to plan 6 months before that. I start selling all my short-term investments, fund myself so that I have enough money to pay my shareholders dividend. So all these small, small things, lot of planning goes in the background, which we are not aware of. Okay. So, but every small things has a huge implication on the working capital management. Okay. I already told you types of working is like rigid, fixed, regular, and variable and seasonal. The Ladakh example that I gave you is a seasonable or a temporary working capital, which is not there regular. Regular means you Jan to December, you're having same business, no change. Okay. For even a coaching academy, for us, peak seasons are or a little bit low season is immediately after the exams, unless they are not launching a new batch. So generally after exam, it's a cool time for us as such. So like that, every businesses will have its peak and cool period, right? Take for example banks. They have a same monotonous kind of business. It does not fluctuate for them unless you have Modi coming and declaring demonetization 2.0. Then again banks have to start doing things faster. So but if nothing that sort has happened, it will be monotonous same. So that's your rigid or fixed working capital. If seasonal your business changes, then you have a variable or a flexible working capital. See, they are showing you in the form of graphs, temporary and variable. Fixed is this line, straight line. There's no change. You need to have a fixed working capital. So whatever may be, I will keep 1 lakh fixed as a reserve working capital. That apart, I keep extra 2 lakhs for my variable anything. Suddenly some big order comes. Some new person comes in, walks in and says, I want to give a big order to you. I should have money, to fund him. So I should keep some temporary or a variable working capital to support to that sudden demand of orders. Now, this is interesting. This is called as the cash cycle. What is a cash cycle? Cash cycle is I start from here. Let's, for example, say I am a sugar industry or a sugar company. Okay. First, for me, if I'm a producer of sugar, my raw material is my sugar cane. Sugarcane, does it come free? I have to go buy sugarcane. So I have to invest in the sugarcane. So my money is getting blocked. From sugarcane, it is getting processed. Entire churning is happening. The juice is being pulled out. So that's my WIP. So I have juice, sugarcane juice fully. That sugarcane juice is further put in big, how we prepare sweets in our house in that big kadai. Right? Similarly, we put those juice and that's stirred and stirred, you form jaggery. So that's finally sugar means jaggery or whatever, sugar and sugar byproducts. That's how it's formed. See, up till here, how much money I had pumped in, raw material. I am pumping in money only. Pumping in as in outflow of cash is happening. From where starts inflow? From here starts inflow. Sales. So up till from raw material till the point finished products are produced, it's outflow of cash. Then I have sales, starts money inflow. In that also, if you give credit to your debtors, that is again pushed. ahead. Cash does not come quickly. But then even when the debtors finally pay you, so this is called as ultimate cash generation cycle. If the shortest you keep it, better for you. If you prolong it, it is going to hit your working capital requirement. Ensure you plan your cash cycle in such a way that it is the shortest and it generates the maximum money for you so that you don't face working capital crunch. This is for manufacturing organization. For trading concerns, it's simple. You buy stock, you sell, and then debtors. You buy, stock it, sell it. Debtors means credit period or otherwise cash sales. So your cash conversion is faster in your trading cycle. In, in service sectors is very, very simple. Debtor and cash, cash to debtor. Simple. Okay. Now these are some of the formulas will be helpful when we are solving problems. Let me read the first formula for you. Gross operating cycle means what? Inventory conversion period. Inventory is, I explained to you in the previous, raw material to work in progress to finish. So that's my inventory conversion period. To that comes your debtor conversion period. How fast your debtor pay you back money. So your operating cycle will be inventory conversion period plus debtor conversion period. The net operating cycle means the same GOC, but I'm going to subtract my credit deferral period. Credit deferral period means you're my creditor. You give me 60 days time to pay you. So that is my deferral. I have deferred the requirement to pay her. I don't have to pay her now. I have to pay after 60 days. So that's your credit deferral period. You already know what is our inventory conversion period. Raw material, work in progress, finished goods. All these conversion period together put together is called as inventory conversion period. This we have read somewhere. Have you? Don't recollect? If not for these, at least finished goods you have read somewhere. Raw material is raw material inventory divided by raw material consumption by in your material, they don't consider 365 unless given in the question. Everywhere they've used 360, 360. Don't wonder what is this 360. It is a number of days in a year. Okay. So raw material inventory divided by consumption by 360. Same. WIP also same thing. But remember here raw material consumption, here it is cost of production. Then similarly for finished products or finished goods divided by cost of production by 360. This formula you know, debtor, receivable or conversion period. Remember we've read this somewhere. Which chapter? Ratios, right? So same thing. Receivables divided by credit sales divided by 360. Remember same thing for creditors as well. Payable divided by credit purchases. Remove cash purchases. Take only credit purchases divided by 360. Yes, for raw materials, I think you will understand this better, but this is, this is very, very general. How do you calculate raw material cost? Number of units, right? So if I say 10,000 units is my raw material and cost of each is 5. For how many days do I want it? For 1 month, 2 months, 3 months. So that I will multiply. If it's in months into 3. So what is going to be my raw material inventory? 10,000 into 5 into 3 divided by, now since this is in months, you have to keep it divided by 12 months. Keep it uniform. If you multiply it with number of days in the numerator, divided by number of days in the denominator. So thereby it is 5. Whatever is this number, that is what you get as raw material inventory. This is 50,000 into 3. This is what 1,50,000 divided by 12. That will be your estimated raw material. What am I trying to do here? I need to estimate, guys. I need money for next 6 months. Can I simply keep some money? How much money I need for raw material? I estimate using this formula. Next, how much money I need for work in progress. Again, I use this formula, I estimate how much money I need. Similarly, finished goods. Since you are in the business, you know generally how much I need. You will estimate for raw material, you will estimate for WIP, you will estimate for finished goods using the same formula. Similarly, how much debtors will pay me? When will they pay me? That also can be estimated using this formula. Cash and cash bank balances, trade creditors, just like how we did inventory, same thing for trade creditors. You will understand this better when I will take up a problem, right? So these are all formulas which we will be applying there. So reading here is making you dozier, but yes, I understand. Yes, this format becomes important because we will use this formula in all our problems. Remember how we did capital budgeting using those three steps? This is the exact formula we'll be using in most of our problems. What are we doing here? We are calculating working capital. We need to find out working capital. So this format becomes important for you. What is the format? You need to estimate current assets. Under current asset, first requirement is cash and cash balances, which the problem will tell. Problem will say, I want to maintain 1 lakh cash. So you will add to it. Then you need to compute for all four of these. Four, okay. Four is under inventory, raw material, work in progress, finished goods, and then under debtors, the debtor part. So all this put together, you get current assets. Then you subtract all your liabilities, creditors, wages, overheads. If problem gives you GST, take GST. Otherwise, generally we don't take GST. Only creditors, wages, and overheads. So that is your total current assets. Then you have total current liabilities. So net working capital will be current assets minus current liability. That will be your working capital required. If the problem say add margin of contingency, this is like a safety deposit. What if I get some extra order? So that is called as margin for contingency. You want some safe money extra added to it. So you add to that and you get your working capital requirement. Fine.